Investor Evaluation of Early Stage Startups, by Rahul Gandhi CPA. In the early stages of a startup's development, it can be difficult to know how to value the business. Investors use a variety of metrics to determine whether or not a startup is worth investing in, and these metrics vary depending on the stage of the company. This video by Rahul Gandhi CPA will discuss some of the most important methods investors use to evaluate startups, including valuation, traction, and market size. By understanding these concepts, entrepreneurs can better assess their own businesses and make decisions about how to move forward. Rahul Gandhi CPA explains investor evaluation of early stage startups. 1. The product or service. One of the first things, according to Rahul Gandhi CPA, that investors will evaluate when considering an early-age startup for investment is the product or service being offered. They will want to know if there is a clear need or demand for the product or service in the market and if the startup has a competitive advantage. They will also assess whether the product or service is scalable and has potential for future growth. 2. The team. Another key consideration for investors when evaluating early-age startups is the team behind the business. They will want to see that the founders have the necessary skills and experience to execute their business plan successfully. They will also look at the chemistry of the team and whether they are able to work well together. 3. The business model. The business model is another important aspect that investors will evaluate when considering an early-age startup for investment. They will want to see that the startup has a sound and sustainable business model that can generate profitability. They will also assess the scalability of the business model and whether it has potential for future growth. 4. The market opportunity. When evaluating an early-age startup, investors will also assess the size and growth potential of the market opportunity. They will want to see that there is a large enough market for the product or service being offered and that the startup has a realistic chance of capturing a significant portion of that market. 5. The financials. Of course, another key consideration for investors when evaluating early-age startups is the financials. They will want to see a sound financial plan that shows how the business will generate revenue and profitability. They will also assess the startup's burn rate and whether it has enough cash to sustain itself until it reaches profitability. 6. The exit strategy. Finally, investors will also want to see a clear exit strategy for an early-age startup, says Rahul Gandhi CPA. They will want to know how and when they can expect to receive a return on their investment and what the potential upside is. This is often one of the most important considerations for investors when deciding whether or not to invest in a startup. Rahul Gandhi CPA's concluding thoughts. When investors are looking at an early-stage startup, there are a few key things they evaluate. First and foremost, they want to know if the product or service is something people actually need or want. They also look at the team behind the startup, their skill set, experience, and chemistry together. Finally, investors consider the business model and how well it can be scaled. If you're an early-stage startup founder, Rahul Gandhi CPA recommends making sure you understand these factors and can articulate them clearly to potential investors. Thanks for watching.